Howdy, Jacob here. Today we're looking at Caleres in the specialty retail industry. 1.1 billion market cap, slightly lower enterprise value. Current P looks extremely cheap at 6.7, but we do see growth is very flat over the last 10 years, just up $200 million or 10% over the last 10 years in total, not year over year. Operating margin is up, however, and so is gross margin. So they are becoming more efficient with their dollars. They've been paying a dividend of 28 cents for the last 10 years, and it is very small in comparison to their earnings per share. So very small payout. Comfortable with that. Return on invested capital, very solid. Okay, so 14, 15, or 14, 16, and 12% the last 3 years, respectively. Very solid, likely above their weighted average cost of capital, creating business, which is great. Balance sheet shows $21 million cash on hand, 182 million short-term debt, no long-term debt. So you want them to refinance this or figure out them to tell you what they're going to do before you invest in a company like this with only 21 million cash on it. I think it's great in comparison to their free cash flow. I'm sure it's very little, but let's see, 182. They're going to be able to make $150 million this year. So I presume they're still going to spend and capital allocate a lot of money towards share repurchases or acquisitions, whatever they've done in the past. So you want them to refinance this quick. You don't want that to get to a point where, even if they can't afford it, like they have $21 million on hand and make $150 million a year, but that's not enough to fund this. So you just don't want it to get to an end point where they can't refinance it. That gets dangerous. I've researched companies where that's happened before, and my novice mind invested in them, not thinking about it, saying that it was no problem. But even if it is no problem, when debt comes due and you don't refinance, you have a problem. They can go after you. And so, worst thing you want to do is do a fire sale, selling off assets 70 cents, 60 cents on the dollar. So they definitely need to refinance that, and if they do, absolutely no problem there. Not a lot of cash in hand, but they produce a good amount of cash flow, so we're definitely not too concerned with that. And only 10 million of their cash flow goes towards dividends, which is less than 10% of their 5-year average free cash flow. A good amount going towards share repurchases, and then a huge amount going towards debt reduction. So of the last 5 years, you're probably looking at 50+% of their capital allocation, probably, yeah, more than that, 60-70% of their capital allocation going towards debt reduction. So what are they going to do when they don't have it? Are they going to buy back shares, hopefully advantageously? Are they going to increase their dividend? Doesn't look like they've done in the past. Or are they going to start making acquisitions, reinvesting back into yourselves? It's not fantastic for you when you're making projections to not have that as data to really go off of here. Because we know that they buy back shares, we know that they pay a dividend, but we don't know what they're going to do with this 50, 60, 70% of allocation that's been going towards debt reduction when their debt is gone. And so that's a positive that the debt's going to be gone, but you just don't know where they're going to become an acquisition company, reinvestment company. I think that's going to go under my assumptions here. So we'll see what we end up, what I end up thinking, and then for you, when you do your own analysis, see what you end up thinking and balance out what the company's done historically with what you want them to do. So when it comes to revenue growth, I think I'm going to be very conservative, say very abysmal 2%. I think a very small P price to free cash flow, as again, if they do start really focusing on buying back shares and the company's still at a 6.7 P, I mean, that could be very advantageous for you as an investor. If they're buying back at a 6 or 7 P or 6 to 7 price to free cash flow, they're going to be able to buy back 10% of their shares. That's going to be a huge yield for you. Or the dividend of, so you could get 10% yield on the free cash flow plus a dividend yield that's paying out maybe, 0.8%. So that's really not a bad investment. But we'll see what we think they'll be doing here. So for margins, hey, let's do 3.5, 4.5, and well, I guess these were more COVID years where they had trouble making money. but then margins are higher now than they were prior. So I think I'm fine with that. For share change, 1% is just $11 million for them. 3% would be about 33 million to offset stock-based compensation. You're looking at about 50 million. That's 40% of their 5-year average free cash flow. It's really not a lot. So let's be comfortable with that. And then just say that they use 40% of free cash flow to make acquisitions to keep these type of margins to get this type of return. I mean, maybe I'm being too conservative here, but to me, I do like longer histories. I don't like reaching. And I think that, if the company gets down to $1 billion and they make $110 million, exactly like I just said, $100 million to share purchases, 10 million to pay a dividend, and that dividend aggregate is going to keep going down because it's on a per share basis. You're buying back shares, and so I mean it could be looking very good for them. But for me right now, I think I'm going to err on the conservative side and just hold off for a sec before I'm more comfortable with their capital allocation. So hopefully you enjoy the video and have a great rest of your day. Thank you.